Let's talk about something that trips a lot of people up, financial terms. You hear words like mutual fund, and it can sound like some kind of Wall Street secret. But what if I told you that behind that complicated-sounding name is one of the simplest and most powerful ideas in investing? Today, we're going to pull back that curtain and show you exactly what it is.
Here's what we're going to cover. We'll start with that Wall Street mystery and why it feels so complex. Then I'll give you a simple way to think about it, like a financial potluck. We'll talk about the pro who's in charge, get a handle on something called net asset value, and then, most importantly, we'll look at your path to actually getting started.
All right, let's just dive right in. First stop, let's tackle that feeling of complexity head on.
So, be honest, when you hear the term mutual fund, does your brain just kind of glaze over? It sounds big, it sounds exclusive, and for a lot of people, it just sounds complicated. But I'm here to tell you that it's actually one of the most accessible tools for building wealth over the long haul, and I'm going to show you exactly why.
So let's get right to the heart of it. Forget the jargon, forget the complex charts for a minute. The best way to understand this is with a really simple analogy.
Think of it like this. It's a financial potluck. You bring $5, I bring $10, another person brings 20. You get thousands of people all putting their money into one big pot. Suddenly, that pot is massive, right? And with that massive pool of money, you can buy a huge, diverse collection of investments, stocks, bonds, you name it. That's it. That's the core idea.
So it really breaks down into 3 easy steps. 1, all the investors, people just like you, pool their money together. 2, a professional manager takes that giant pool of money and invests it for everyone. And 3, you own your own little piece of the whole thing, your slice of that entire investment pie. See, it's that straightforward.
Okay, let's zero in on that second step, because this is probably the biggest advantage, the professional. This is the part that means you don't have to go it alone.
And this right here really says it all. Instead of you having to spend your nights and weekends researching hundreds of different companies, trying to pick winners, you're basically hiring a pro. Their full-time job is to manage that pot of money. They do all of that heavy lifting for you.
Just look at the difference here. Going it alone means endless research, a ton of stress, and, it's hard to diversify with limited funds. With a fund manager, you get professional expertise, the work is done for you, and you get instant diversification. Now, some of these managers are actively managed, meaning they're trying to beat the market. Others are index funds, which just track an index like the S&P 500, usually for a lower fee. But either way, the day-to-day grind is off your plate.
All right, let's talk about a detail that most beginners just completely miss. This is a bit of an insider's tip, but it's crucial for understanding how these things are really designed to be used. It's called net asset value.
So here's the kicker. You know how a stock's price is jumping all over the place every second the market is open? Well, a mutual fund is completely different. It gets priced just one single time per day. That's it. And that's by design.
And that one price has a name. It's the net asset value, or NAV for short. It's calculated after the U.S. markets close, at 4 p.m. Eastern Time. So if you put in an order to buy at 10 a.m., you won't actually know the final price you paid until the end of the day.
And this table just lays it all out, crystal clear. Stocks, with that constant pricing, they're built for day traders. Mutual funds, priced once a day, they are intentionally designed for the long-term builder. It is a feature, not a bug. They're telling you, hey, slow down, this is for the long haul. And because of that long-term focus, getting in the game has gotten easier than ever.
So you get it. You understand the concept. But how do you actually start? Well, let's talk about the practical stuff, because the old barriers, they've pretty much been torn down. For the longest time, there was this huge hurdle. You needed, $3,000, $5,000, sometimes more, just to open an account with a good mutual fund. It kept a lot of people out. Well, that world is gone.
Companies like Charles Schwab have completely changed the landscape. They give you access to thousands of no-load funds. That just means you don't pay a sales commission to buy or sell. Now, you will see a small annual fee for the management, called an expense ratio, but the big thing is, they've gotten rid of those high initial investment requirements. It's made professional diversification available to pretty much everyone.
So what are we talking about when we say no high initial investment? How low can you go? Well, there it is. For many friends, you can get started with as little as a single dollar. The idea that you have to be rich to start investing, it's not true anymore.
So let's just wrap our heads around the philosophy here. When you buy into a mutual fund, you're not trying to get rich quick. You're not a day trader. You're consciously choosing a steady, professionally managed path toward building wealth over time. It's a disciplined approach.
And that really brings us to the final and most important question. Now that the mystery is gone,
Now that you understand the what and the how, the only thing left is your why. We've demystified the tool itself. The question for you to think about is, what could that first dollar, your first slice, what could that help you build for your future?